Hello and welcome to the Trading Zone. I'm Joe Teague of Equity Armor Investments, and with me is
Brian Stutland here, Equity Armor Investments as well, portfolio manager. Joe, happy Monday here. We're finally having an up day, so things are on the move and really a lot to talk about.
a lot to talk about. Let's give everyone just a second to settle in here as they're arriving to the show. I want to thank everybody again for joining us. If you're watching us live, you're early. Say hi to us. And if you are watching us on recorded version, we're here every Monday, 1 Eastern time. So we're here in the middle of the day to talk about the markets, talk about volatility, talk about portfolio management, three things that we love.
Yeah, and when we discuss it, we give sort of our macro view on the world. We give our view on where volatility might be going, and I have a good trade. I think that's maybe a little different. We talked so much about technology, Joe, but I've got a little different trade at the end to get into. As we sort of wait here, Joe, your Lions snuck one out late last night, huh? Just pounding the ball down the middle of the field in overtime to get it done.
I'd have to say that's brand new Lions, because the Lions that I grew up with, they would have lost that game. So
100%.
They found a way to win, but it looked a lot like the old Bears to me. They just had a huge defensive and special teams game. That was fun.
Yeah, my Bears was, I guess we'll just maybe never figure out how to get the offense actually going to win games for us, but it was fun to see good old Bears make some plays. It was kind of interesting when Will Levis threw the interception. That was a pick six for the Bears to take the lead. Kind of interesting clips. He threw it, and then he just, as the guy was running back, he didn't even get up to try and make a play. He just like sat there with his knees and his hands on his head, like, "Oh my God, what did I just do?" Kind of funny.
That was a lot of fun. The NFL just is a lot of fun. Every game is just close, it seems like, and that's just a lot of fun to watch. Different than college football, where you get some blowouts, but the NFL is just incredibly. Every game comes down to the last drive.
Yeah, but as the NFL season starts, Joe, so does the volatile times of the market. September, October, as we know, the VIX on the rise. Historically, September is never, or historically not. I wouldn't say never, but it's typically not a great month for stocks.
The bad start last week, I gotta say.
Yeah, it certainly was coming back a little today. So what do you say? Let's get into it.
Let's kick it off. Let's go. Here we go. Let's launch the show. This is the Trading Zone. Joe Teague, former VIX market maker, current portfolio manager at Equity Armor Investments. That's the same for Brian Stutland. And yeah, we're going to look at the markets right now. This morning, we're coming into some global weakness, seeing some weakness coming from China right now. They're getting some deflation in China. There is, really struggling economy right now. Things are slowing down right now. Maybe that'll be good for the yen carry trade if that'll spill over into Japan and they won't have to raise rates. I'm not sure. Maybe that's giving the market a nice little breather today, but certainly we have the same issues we had last week, but maybe the same potential benefits we had last week, where we were saying this is a market that could be like 2007, where we're seeing job losses start to accumulate. The Fed's about to lower rates, or it could be a market like 1998, where we had a false uptick in job losses, and then the Fed lowered rates and the economy accelerated further.
Yeah, I think it was positive that the unemployment rate kind of sat still on this last data. I'm still waiting for October, November to see how that works out, to see if the trend is still upward, sideways, or back down for the unemployment rate. But certainly, you mentioned China. I think that's the big news. I think that's what rallied the markets in the middle of the night. I was on CNBC Worldwide this morning at the early hours of 5:15 a.m. Eastern, and talking markets and option trades that were going on. And, I could see that VIX futures were down pretty sharply. The market was up, and I think it was all off of that China news that maybe globally inflation is sort of settling in back into this 2% range, and now we can start to proceed to lower interest rates.
Yeah, well, China's just been a conundrum. Like, people have been talking about their slowdown. They need to do some stimulus. They need to have some sort of action. They've been really slow to do so. Is this going to happen now? We'll see. If they do it, usually quite large, and their stimulus usually does spill out to around the world if they finally can get something going. We got more moving parts this week. As you can see up here, PPI is going to be big. We know the Fed's going to cut in September. We're still unsure if it's going to be 2 cuts, 50 basis point cut, or a 25 basis point cut. Market's leaning towards 25, but they're also pricing in like a lot of cuts by the end of the year. I think the CPI, PPI will be a big component of that, as well as the rest of the jobs reports coming up. And then, of course, we have right now, as we speak, the Apple product launch. Our stocks recovered off the lows from this morning, but really important for me for that AI trade to see companies finally start to sell these AI products to retailers. We're seeing a lot of big companies spend a lot of money buying NVIDIA chips and servers, but they haven't yet passed down that bucket or haven't yet figured out how they're going to sell it, how they're going to profit off of AI. So big announcement, big launch for me. I'm curious to see how the market reacts.
Yeah, and we just got underway. Actually, I'm watching here. I have it scrolled up on our Bloomberg news ticker. Tim Cook is now speaking. First thing is, new iPhones are designed from the ground up for Apple intelligence, is what basically his first statement is. So we'll keep an eye on this. The stock has been moving up since the open, headed into this event. So that'll be interesting. And then if you look at that list there, presidential debate Tuesday night, CPI, PPI Wednesday and Thursday. We've got the iPhone coming out right now. And so, these are going to be all market movers. And then we'll get back to, we talked about deflationary. Our big story, just to tease you up a little bit on that, is talking interest rates and where they're going and the cycle that we're in. So we'll definitely get into that later on in the show.
Yeah, well, let's get into some volatility news, of course. But as we do so, speaking of which, if you've been following us for a while, you'll remember this chart from last year, even when people were talking about the Fed might start lowering rates. And at that point in time, I was saying, be careful what you wish for when the Fed does go ahead and lower rates. It's usually not the best news for the stock market because it usually couples with the economy slowing down, of course. Well, on average, the market is down 23% after the Fed lowers rates. And on average, it takes 195 days to bottom. So we have to look forward to in about a week and a half, Brian.
Well, that's kind of ominous to me, isn't it, Joe? I mean, especially when you look at some of the other situations there, really only 1980 was positive for the markets. I mean, maybe you can make the comparison that we're sort of in that because there was such massive inflation in the 70s, and maybe it's 1980-ish kind of thing where now, inflation is settling in and they can start to lower rates and then the market can rally because obviously, good times were had, shortly thereafter. But, even take out that one data point of positivity and it looks like there's a lot of even more negativity.
Yeah. So we'll see. It doesn't have to be like this. It could be different. We've talked about how much money the government is spending in deficit spending. So maybe that'll make things different. Certainly a possibility to me. When it comes to volatility, we've seen a recent spike up. Of course, this is the skew index. This measures the volatility of S&P 500 puts 1 month out versus S&P 500 calls 1 month out, 25 delta put versus the 25 delta call. This is something we track every single day as we're watching volatility, and it's really crucial to see if people are paying up for downside protection and compared to the price they're paying for the upside calls in terms of the skittishness or nervousness out there for the market, and something we track closely with all of our trading. Have not made a huge move necessarily this week. We did kind of have like another little spike higher, a mini spike compared to the start of August, massive spike. But we're coming back up with those levels right here.
Yeah, I haven't seen anything though that where like call buyers have just come in and all of a sudden put buyers disappear yet. So typically when the market has bottomed, we see that after the skew's gotten bid up, people have come in to buy insurance and buy puts on the downside. You get like a dramatic shift the other way, and then that usually snowballs and then rallies the stock market to the upside. We haven't quite really seen that yet. So that's the one thing that leaves me a little skittish about where this market can go. And is this today's rally just a sell the rally kind of day?
Yeah, I mean, I think what you're saying is on a lot of these peaks here, you can see a very sharp reversal off of that. That's not necessarily what we are seeing today.
Yeah. And so that's something I typically, if I'm going to look at this and see this as an indicator of let's buy the market now after a sell off. I don't think this is giving us that indication just yet for that purpose.
Yeah, we got a nice question here from Jack. Thank you, Jack, for tuning in. Remember, all of you other viewers out here tuning in, feel free to shoot us a question. We're happy to answer them. Jack asks, how is today's volatility affecting how you plan your trades this week?
Well, I mean, I would answer that. I think one thing, Joe, that we're looking at for clients right now is, given the level of volatility that we've seen here and sort of the choppiness, especially, the lack of leadership that we've seen in the market from, the semiconductor sector, for example, the NASDAQ, for example, all these indicators kind of lagging along with, sort of a flight to quality into the treasury market makes me a little bit skeptical. And then you have all these events coming up. We got 2 unemployment reports, an election by November, a couple Federal Reserve meetings. So one way that I'm looking to sort of play the market, especially on a day like today where volatility has come off a little bit, I'd probably look to be a call buyer of something, slightly at the money or slightly out of the money in order to initiate positions. I think that's something that I'll look to probably be doing for clients later on today, and personally for myself. So I think that's kind of how you want to play to the long side, to the upside right now, is using call options to do that. Given the level of volatility, then I only risk the premium of the call that I buy.
Yeah, given the level of volatility, you're risking just a premium. You have less exposure to a big correction. Yeah, just final point on the skew. We are seeing a much bigger drop in the VIX today compared to the skew today. Does that give you any insight, Brian?
Yeah, I think when you look at the skew here, kind of like I issued before, is I think I want to see the skew come down, to be more comfortable about, what the upside is going to look like. And for now, I can just dip my toe in the water by buying a call because I have a smaller, what we option traders like to call delta to the market, or percent exposure to the market kind of gets lowered a little bit. But if we blow through that call strike, then I'm back to 100% in the market, and I'm okay doing it that way.
Yeah, 100%. And for me, I would rather it were reverse. If I were a market bull, kind of, I think I'd rather having the skew down more than the VIX index. I think that'd be like a little bit of a leading indicator. Like the put buyers are kind of not really there when it comes to volatility continuing tomorrow or the rest of the week. So I think that's one worry I have for the rest of the week, is that the volatility's down. That's good. Market's higher. That's good. But the skew index, there's still some people, stubborn put buyers, saying, hey, I'm worried about the rest of the week, which for the reasons we talked about before makes a lot of sense. Here's what the VIX futures look like here, Brian.
Yeah.
Go ahead.
Yeah, you're seeing basically elevated back to where we were almost a month ago, but not through that, which is maybe somewhat of an encouraging sign, because maybe it means VIX futures are dissipating a little bit relative to where they were before a month ago. So even though we've seen a market sell-off, and what's interesting, actually, the S&P 500 made a perfect 50% retracement from the August lows to the highs, or the start of September. So it hit that 50% mark. The market's bounced off of that. That'll be a key level sort of to watch. Just taking a look at it, that's somewhere around the 54.50 area on the S&P futures E-mini. And so I think the VIX futures are sort of echoing that maybe it's found a level to sort of stabilize, and that's why you're not seeing the VIX futures elevate above to where we were a month ago.
Yeah, let's hope we don't. Certainly ready for that occurrence. If it does, lots of events still on the horizon. For us, we've been really kind of watching these trend lines that we've been pointing out every week. If you're new to our show, this is something we look at every week, is these trend lines. S&P 500 kind of stuck in no man's land here. We dropped below this accelerated trend line. We're kind of in between the two trend lines. It's good that we're still above the first trend line. So, I mean, I guess you can absolutely say that we are still in a long-term bullish stance still that hasn't broken. So, but we're still very cautious. We might see some consolidation here. Maybe that's the best case scenario for the bulls to consolidate here, but need to see these this at least flatten out before it can go higher.
Yeah, I mean, I think that's why I want to be a call buyer and just risk some premium that I have for right now in the calls I own, and look to hopefully get a bounce higher. But if it goes lower, that's okay. I've only outlaid the cost of the premium of the calls, and then I can find different levels lower to get in.
And a perfect example of an area which we would be interested in being call buyers is semiconductor index. This just is very scary here. I mean, we're at a spot here where we are right on that right shoulder here for this head and shoulders. Would not be good if we broke below here. We are still above it, so benefit of the doubt still here for the bulls, but it's precarious. I need that protection. This is a perfect example of what you're saying here, Brian.
Yeah. All right. Well, the name of the show here is Are Interest Rates Going to Zero? And Joe, I think we should get into that and talk about the. Yeah,
we love talking about AI and chips.
Yeah, I know. It's like you have this technology revolution, and you're excited to just talk about that, especially on a day with the Apple announcements that are going on right now. But I think this chart right here is very interested at where are we with interest rates? What does that mean for volatility? Joe, maybe this circle of life, you want to describe this to people?
Yeah, it's always what happens when we die, Mufasa? Well, our bodies become the grass. Well, yeah, that's what happens when the economies die, interest rates go lower, and that fuels new growth. That's essentially what this is, and this is our bread and butter, Brian. Here, this is what we've been doing. This is from 2008. You can see this cycle, and this is just what we have to expect. Now, currently, we're at a spot where the yield curve is very flat. We're looking at, this is a chart of the 3-month, 30-year yield curve. So we're at a spot where that's very flat. Now, typically that is like the lower left quadrant of volatility. You can see, so we are essentially right, this is 23 right here, but we're essentially down here where we have low volatility, low yield curve, and we finally started to pick up on the yield curve. The yield curve has started to get steeper again as it went positive, and we're going this way. And volatility, not surprisingly, has also steepened. So we know the yield curve is going to get steeper. The Fed is going to be starting their rate cut cycle. So we are going to be going up this way on this axis. And every time you go up this way from here, you end up in this area for volatility. So that's what we should be aware of and just prepared for. I'm not saying it necessarily has to happen, but in my career, this is what we've seen.
Yeah, I think for volatility to experience low volatility times, we would have to see a quick steepening of the yield curve and then it stabilizing and just sitting there for a number of months. And then, we might see volatility come up. But, to your point, Joe, as we start to see the yield curve steepen back out again, what we tend to see is higher VIX volatility levels. So a 20-something VIX becomes more normalized. And then, throw back when you look at a 20-something VIX or higher that stays above there for a long period of time, that is typically seen in recessionary timeframes, in timeframes where it's, sell the rips and in the stock market and look for better levels to get back in again, or just look for areas to short, which are when you have extreme moves to the upside. Those are times to initiate short trades on the market.
Yeah, and we're also kind of like right in this spot here. You can remember, like, this is like the 2008 time. that's when that's like the most troublesome time when we're shifting. We're going from a flat yield curve to starting to pause the ramp up again. So that's why we brought this up again. This is something we brought up a few times in our shows in the past. Just wanted to bring this back out to you guys. Just remember, this is a time we should expect some volatility here. But after the volatility period, things are going to get better. So we just need to get through this bumpy period. We need to get back to an area where we have a positive yield curve. And when it does, we'll do quite good because there were some really good years in there to 2010, for example. For the market doing better, and then of course once we get through all that, then it really started to get good after that volatility.
Yeah, I would probably look for opportunities to, if somebody was looking to put cash to work or looking for areas to get in, I would say, we might have a period where you see VIX spikes, above 30, like we did at the beginning of August, temporarily, would seem to be for like 30 seconds, but it did get, it did rocket higher. But when we see those VIX spikes, those might be opportunities then to buy the market because, Joe, like you said, then you could enter a period where you have very many, many good years, especially once the yield curve sort of stabilizes into a steepening position that it's comfortable with.
Yeah, absolutely. I think that's it's good advice just in general for me. When the VIX is very high, it's usually a time to buy.
Yeah, and we rebalance portfolios for our clients when that occurs. So that's something I would be looking for. I think in terms of interest rates, Joe, we probably should spend some time looking at where these things are going, and can the yield curve even steepen out, or will the back end of the curve now find a bid, meaning interest rates head lower? And I look at some of these technicals, and the answer might be yes, temporarily.
Both can happen. The yield curve can steepen, and these can go lower. In fact, I do expect if the 3-month is going down, the 10-month and the 20 and the 30-year, the 10-year and the 30-year will each be going down too. So, but just at a slower pace. So I do expect that to happen. It's just a question of how much, and are we just kind of at an inflection point where it's just this is going to be the highest yields you're going to get for a long time.
Yeah, well, I don't know if this is the highest yield you're going to get for a long time, but I would be a buyer of longer dated treasuries actually at this time. It's one of the rare times. I mean, look, inflation thing is kind of a problem. It's still a hidden thing, but we are a lending nation. Our debt is big, and it's in the benefit of the U.S. to see lower interest rates, to borrow at lower rates. I'm not saying it's conspiracy theory or anything like that, but there is this downward pressure in it. And, I think we're okay with a little bit of inflation so that we can borrow money cheaply. And when we look at that, and you look at the charts and the technicals here, I think, in the short term, there's some areas a little bit lower. 3.25% on the 10-year would be one level, I think, that could get triggered and hit now that we've sort of broken through support lines. And if the economy gets really bad, then now we're talking about above the 2% level or so before we bottom. But one thing to watch out, we drew this little resistance line up there, is that we get this massive head and shoulders bottom where now the 10-year goes back down to, let's say, 2.5% and then starts pushing higher. Look out. Hopefully inflation doesn't come back if that were to happen, because then, the upside is kind of dangerous.
Yeah, we'll see. We had a whole decade worth of no inflation. We had a whole, back in the aughts where inflation didn't come, and the teens, inflation wasn't really there. We caught up in a big way in 2022. That inflation all came back. But yeah, it's just amazing how it's been. We've been very rocky, and we were talking, it's just strange that we got so much inflation in just a year, and then things have come back down to the baseline. We're inflation just at a slower rate. That's like a win for us right now, but we're still paying extremely high prices for everything. Is there ever going to be any relief?
Yeah, we'll see if that really happens. But I will say this: I think now that the 10-year broke 3.8%, I thought that was a pretty key level that it got below. I do think that 3.25%, 3.27, really, if you look at some of the technicals, is in the cards. And for that reason, and then we talked about the volatility picture that we're seeing and the potential for volatility rises. I think if I was looking to sort of diversify my portfolio, I'd own two things. I'd want to own volatility. I'd want to own some longer dated treasuries as a good mix, because I think those two things with stocks right now will provide a very sound portfolio that has a little bit less volatility in it, but doesn't really give up upside returns, because I think the pressure for volatility to move higher is one, and I think the pressure for treasuries to have a bid is higher as well.
Yeah, absolutely. I mean, this does look like it wants to just come down and test this retracement level here, and then we'll see from there. I mean, it looks even more bearish, I think, from a rate perspective, I guess. On this chart, it looks like rates just kind of broken this trend line here, and looks like they want to trade lower. And this is on the longer dated, Brian. This is on the 30-year time frame. This is a condensed version of a 5-year chart.
Yeah, I mean, to me, this is like, mortgage-backed security area is like the 30-year area.
Mm-hmm.
Are those going to perform well or not? And it does look like something like that is in the cards to do a little better when you look at the 30-year and this.
Or just treasuries themselves owning them.
Correct. Yeah, for a number of period and getting actual performance out of them besides just the coupon payment that a bond makes. Remember, folks, when you buy a bond, it does pay a coupon, and if you're willing to buy and hold it forever, you can just collect that coupon. That's fine. But if interest rates move, if they go lower, then the value of the bond that you're holding in the coupon payment becomes more valuable, right? And the value of that bond you're holding becomes more valuable. So, so this might be a time to step in and buy something on the back end.
Makes a lot of sense. We'll see how it plays out. I think, to me, the U.S. government holds a lot of debt. It's very expensive to service that debt. It just makes a lot of sense that they want these rates to come lower. The inflation is being reported by the government. Again, not to be a conspiracy theorist, but it makes sense. They want that inflation to look lower, so these rates are lower. Essentially, the government is just borrowing today's money, paying it back at this money, which is not the same. So as long as the economy can grow, faster than they're paying on this interest rate, minus the inflation, I think they're doing just fine. I think they have been historically doing just fine. Right now, however, the amount of debt we're piling on, it just kind of makes it seem untenable. Again, we'll see how it can play out.
And yeah, I do actually want to get a trade of the day and get to that. I have a trade on the TLT. But before we do that, I actually just want to give an update. A lot of talk on the Apple. I'm just, if you see my eyes turning to the side of the screen, I'm watching what's coming out on this, Apple news. What's that?
They're back to unch on the day.
Yeah, Apple stock is back to unchanged. A lot of talk about the Apple Watch right now, actually. Apple Watch Ultra is getting a new Hermes band. For all you watch geeks out there. But nothing really that new and exciting. The watch will start at $399 and will be available in September. The band looks kind of cool. A little different style to it. But again, nothing.
That's not news, but that's not news for me. Tim Cook's got to come back and say one more thing. I'll let Steve Jobs see if he can do that, but until then, yeah.
Yeah, well, let's see if he does that by the end. So, we traded it. We bought a put spread as protection, knowing that historically the events have been somewhat negative for Apple. Historically, the stock is traded lower on the day, after the event ends. So we wanted to buy a put spread that kind of caught the wind of the market as well behind it. So we're a little bit, a little bit of a winner here on the put spread we described. So if you put it on as a trade, I personally would be taking it off if I owned Apple stock, I probably would continue to hold it.
Which is kind of our thesis. This is a kind of a hedge against Apple and our positions. And
yeah, I mean the put spread's not in the money; it's up in value, but not in the money. So if I was long Apple stock, I would probably continue to hold this put spread and just handle the protection in case the stock market heads lower. I think it's still pretty cheap put spread to own for this like time frame.
All right, well, let's get into the TLT discussion. If this were just a stock chart, this would look kind of good, Brian.
Yeah, it really would. And so I want to use puts to play TLT, but I want to do it in a bullish sense. So how do I do that? I have to sell puts, because that means I'm willing to sell insurance, or I'm willing to be put to the stock and take delivery of the stock if the stock were to move below my strike price. So when you look at the TLT trade, in the 30-year treasury trading around 4% yield, I can add more yield than what the yield is paying, believe it or not. And that's by looking at the September option. This is something that's going to expire in just 2 weeks, and selling the 99.5 put for 75 cents. So think about it. I'm going to collect 0.75% in 2 weeks. If I did that 25 more times, or 26 more times throughout the year, I would be up a whole heck of a lot more than what treasuries are paying. So this is a way sort of dip my toes. If I was willing to buy the long end of the curve, this might be a way I would want to play it, by selling the put. I don't think rates are going to rocket lower very quickly this week. They might a little bit, and maybe I would have been better off buying TLT outright. But I want to collect some premium, and I want to have a level that I'm willing to be put to. And I think these values make a lot of sense with implied volatilities trading at fairly high levels for bonds.
Yeah, and I think this is a trade that I like a lot, because I think the September cut is going to be 25 basis points. So it's not going to be a shock to the market in terms of this yield. But I do think longer term, I think we'll be leaning towards these rates coming down a little bit faster than the Fed has previously thought.
Yes, exactly. All right, so before we wrap up the show here, just want to give one last little update on Apple. Shares of ResMed, a company that treats sleep disorders, actually up 4%. Maybe there's been some talk that they're going to improve their sleep apnea data with the Apple Watch. So, hey, maybe you sleep a little better.
My watch battery does not last long enough to sleep with it on. I don't know about yours.
Well, then this battery better be better when it comes out on September 20th.
That would be nice to have that. Yeah, and I'm sure in certain areas there's a very specific case for some of these people with more severe types of apnea. I think that could be, which is a lot of people, could move the needle, especially for that one company.
Yeah. All right, well, that's going to wrap up our show here today. Thanks for tuning in on the Trading Zone. We are here every Monday, 1 p.m. Eastern. Tune in. I wish I could give you a little bit more about Apple, but I got to go trade. Joe's got to go trade, so we got to get at it. So we'll be leaving you here, but tune in every Monday, 1 p.m. Eastern. We'll see you next week. I'm Brian Stutland here from Equity Armor Investments with my colleague, Joe Teague. We'll catch you next week.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.